one of the most frustrating things as a trader is when you predict a move in the market, you place your order, you get tagged in, you get stopped out, and then price runs to your take profit. It is so frustrating, and often it's because you've missed a key point of liquidity in the market that price is targeting and needs to be swept before it actually reverses or continues to the area that you think price is heading. So I want to show you how to spot liquidity sweeps on your charts and how to look for the right confirmation to trade those sweeps. And we're just going to do that by first covering a bit of theory and then going on to look at price action for New Zealand dollar versus the US dollar. So let's take a whistle-stop tour of liquidity, what it is, how to spot it, why liquidity gets built in the market, before we then go on to look at examples on our charts for New Zealand dollar versus US dollar. So I'm not going to spend ages here, but I think it's important to just cover the basics. So liquidity is essentially a cluster of resting orders in the market. So liquidity tends to sit above old highs or below old lows in the form of buy stops and sell stops. And market makers are basically targeting these levels to do two things. One, to fill their orders, and two, to entice new entrants into the market, either breakout traders or those thinking that prices are going to continue in the same direction, so that they can entice more liquidity that they can then target to collect even larger orders that they can then distribute through reversals in the market. So what is a liquidity sweep from a visual perspective? So you can see liquidity sweeps occur when price breaks beyond an old high or low before reversing in the other direction. And I've just added often with a candle wick because that's what you tend to see. You do see candle closures to really entice those breakout traders into the market looking for continuations. But often what price will do is it will just wick below an area of an old high or an old low before then you see that structure shift to the opposing end of the range that you're trading. When you're actually looking at price develop in real time, what you'll see is that this candle here at some point in that candle's journey will look like a very strong down candle. So it will look like a breakout. So what that sweep is doing is it's enticing people to think price is going to continue. They FOMO in, they enter positions, they have their stops here above these highs. And then what happens, price just closes, wicks below, and then aggressively moves in the opposite direction. So orders have been collected below the low, new breakout traders have been enticed in, and then they've been targeted on the actual distributing move. So it's a twofold effect where sweeps are looking to first target orders, but then also entice new entrants into the market that can be targeted in the opposing direction. So without covering the same ground, because we've walked through the theory of why liquidity sweeps happen, all you really need to understand is that it's about manufacturing liquidity to fill large orders. So if you're looking to place a trade and you note that liquidity at a key level above where you're setting your stop loss has yet to be targeted, there's a very high probability that you're going to get stopped out before the actual move in the market happens. And this is the reason. You might be right, but you're just entering your trade at the wrong position. So how do you identify those high probability liquidity pools? Again, it comes back to old highs and lows in the market. So what I have here is a completely clean chart. I'm looking at the 12-hour time frame. And what I've just done is added two time frames behind the actual price action on this time frame. One is the 1 month time frame and the other is the 1 week time frame. So just to make this explicitly clear, you can see for the entirety of June, we have this specific price action here. You can see that entire blue candle is the range of price action between June and July. And that's represented, we'll just take everything else away, in this blue candle. And you can see it closes above this high, and it's a bullish candle. Then what I'm doing here, if I just take that away, is adding the weekly price action as well. So in combination, we have the 1 month time frame, the 1 week time frame, and then we're executing or looking at the 12-hour time frame. And then what we can do is start to piece together liquidity sweeps with structure shifts to actually take higher probability trades when key liquidity pools have already been targeted. And I'm going to show you or walk you through how that looks and what that can actually look like. What I'm going to do is just quickly take away the higher time frame, and let's just start by looking at, from a structural perspective, what's happening in the market and what you could make arguments for in terms of higher and lower prices. So we have this high being taken and closed above. Then we have a further low, new high, a low, eventually a new high, and then a fail to close above the high and a close below the low. So at this point in price, we have bullish structure being respected from a traditional sense, and then fail to close above, structure shift, and we're now in a bearish market. So for anyone that is looking to get involved right here using this type of logic, what you'd expect to see is a retracement maybe into here or higher in this price leg to go lower. So first and foremost, liquidity is starting to build for short positions. So if you want to get in here and you maybe have like a very super conservative stop, you've got that type of trade. Or maybe you want to get involved off of this fair value area, same thing, or off this order block at the top here. And I'm just talking about trading structure. So irrespective of profit targets, I'm just trying to paint a picture of where people or actors might be getting into the market and placing stops at this high. So for all the time that we're in this bearish action, liquidity is being built here. So what does price do? It targets the liquidity before returning bearish. So we've targeted the liquidity at this high. In addition, what do we do from a structural perspective? You could argue at this point here, we've now shifted structure. So we're enticing longs into the market. People might want to, or actors might want to take long positions off of this area here, breakout traders. And all the way down, if you've got this type of structure mapped, you might be thinking, okay, this is actually where we want to make new highs from. And once we get this type of move here, same thing's happening. Everyone's getting enticed thinking, we've got this bullish structure, now we're going to go and target the high. So it's new liquidity being trapped or attracted into the market, which instantly gets hunted. So that's first and foremost liquidity being built on the chart. Now, if we take this away and then we introduce back our higher time frame candles, what is actually happening? So if we take this high, for example, we're saying this from a purely structural perspective may look like a high in the market that is going to be respected. But what it actually does is it gets hunted, because as soon as the monthly candle closes, you can see to this high, this is our entire range of monthly price. This becomes a candles range high right here. So price trades into it, sweeping the liquidity that we've just discussed being built above that high. Secondly, printing bullish price action with the formation of this order block right here, this 12-hour order block. And instead of price continuing in the same fashion and respecting this to go higher, instead what we see is that we just trade straight through and then ultimately target the lows of the candle. So a liquidity sweep right here is the sweep of this high, this candle's high. So first and foremost, we can actually go on to confirm this as a monthly sweep. I'm just going to actually just change the color of that candle there. So as you see, once this candle closes, it did in fact close a sweep of this candle. But just in terms of the actual price action, price traded above the high, and then what do we see? We see a shift. I'll bring this back to this color here. So this can now act as our confirmation. And if we're tracking then the subsequent order blocks that get formed, you see first and foremost, order block gets formed here. So this bullish candle here that actually liquidates the high then turns into a 12-hour supply zone. So price then, following the liquidation of the high, shifts. We get a reaction, gets disrespected, and then the order block itself is formed, and then it can be used to target much lower. And we can then discuss what happens here secondly, but essentially you have a short which you can take from the order block, stop above the high, targeting the low of the candle, and you've got a 4.12 RR trade. And that is simply from watching a liquidation of an old high that is created at the close of this monthly candle, and then targeting the opposing end of that candle's range. So that is the logic here. Now, if I just take away the monthly candle and we just look at weekly candles here, you're then getting this exact same picture whereby we're having candles getting liquidated. So this would be a weekly liquidation. You see, right here, we have this candle's range, this weekly candle's range. So irrespective of the monthly candle, we had a bearish close of this candle. We were looking from a structural perspective at shorts here, but what you're actually seeing is that price digs below the weekly low and then shifts. And this is where market structure comes into account. You have bearish price action, highs, lows, shift. So the actual structural shift is right here. That's the shift that you should take notice of. That shift right there, because you have a liquidity sweep whereby price traded below an old low, shifted, and now we can use potentially this breaker block right here. I've got another video on breaker blocks to target the opposing end of the range. That would be a 2R trade. Or even if you just wanted to take this entire flip zone, 1.56R trade. And then what happens? We have, as I say, the liquidation of the monthly candle, the sweep of that candle's high. If we take that away, what also happens? We sweep this high, which is the monthly high, but also this bullish candle's weekly range. So that is the range of price action for this bullish week. Price traded up, liquidated the high of the candle, and then shifted structure. So the actual market structure shift, again, that we want to take notice of is this one right here. Not this structure shift here to say we're in a bullish market. No, this structure shift to say we're in a bearish market. And so then it's a case of plotting points of internal range liquidity to take trades from. So you have, for example, the fair value gap right here that gets respected, or you could look at the order block potentially. And what happens? We then trade lower. So this shift is respected, and then we're starting to make our way down to the candle range low of this candle that was liquidated. However, what we also see is this reversal here, and that reversal is exactly what we talked about earlier. It's manipulation to entice new liquidity into buying here, this breakout, on the basis that we've seen a structural shift here. But that structural shift is just purely manufactured. And what ends up happening, if you are just to be patient, is that price does start to turn bullish. And what's it doing? It's just simply sweeping more liquidity for this high and ultimately this high. So you've got price targeting this area where stop losses have been building from traders looking to target this low. All of those traders have been trapped and liquidated before we actually get the move. And what you see is that at the point that this particular candle closes, we then have a confirmed liquidation or a sweep, liquidity sweep, of this candle and this candle. And given the higher time frame, the monthly sweep here, we can then be very, very confident that structure is going to be respected to target the lows that we had originally marked. So then you have, again, 12-hour order block right there with a fair value gap, which is created right here. So we can then take that there as an entry, covering the high, stop above the high, the liquidation, to target the original low, 2.88R. And structure is just then respected all the way down. New 12-hour order blocks being created until they're not. And then it just builds again. Another liquidation right here of this weekly high. So it's a sweep, shift, sell-off. And this just happens over and over again on every single time frame. So if you want to day trade, you can do the exact same thing with candles on lower time frames. For me, I like to swing trade, so I'm always looking at weekly, 2-weekly, monthly candles, looking for these shifts in the market that I can then ride to target the opposing end of candle ranges. I have specific videos on candle range trading and when to take trades and when not to take trades. But liquidity sweeps are so pivotal to this, because you will not get these moves in the market without liquidity first being hunted and then reversed on. And it's about spotting when the right liquidity has been swept for that move to occur before actually entering your trade. And if you can do that, you can be very, very profitable in the markets. So that is how to identify and trade liquidity sweeps. What you then have is internal range liquidity. And this we can go into in a lot more detail. But what you'll see is that if I just take this away, and I'm just going to draw back this particular liquidation right here, the sweep of this low. What you see is that as price continues bullish and we get this bullish price action, internal range liquidity is swept before or on the way to this particular target. And you can see this happening right here. So this is a fair value gap right here. So in the price leg, just to be explicit, this price leg here that gets created, there are points of internal range liquidity in this price leg that you can trade from. And maybe you want to get onto the smaller time frames to take those trades. But you can see, and I'll just take away the candle just to make this much more explicitly clear. You have here your order block, which I'll mark as a 12-hour order block. So this zone here, the last sell candle before the buy. You then have a fair value gap, which is the imbalance between candle 1 and candle 2. And what does price do? It targets the low of this particular candle before going higher. And then you get a new order block created. let's call this our 12-hour order block. So I'm just going to move this to that area there. Here's the order block, and then you also see that there is a fair value gap that also gets created, a small fair value gap right there. And there is a new liquidation of lows in this area here. So you can see that price first, it breaks out, it targets the liquidity, the fair value gap, and even tags this order block here before making a higher move. So we have our key liquidity points at monthly highs and at weekly highs. And then within these areas, we also have our internal range liquidity that sit in these specific price legs. And price is constantly targeting liquidity pools in these areas. And I'm sure if we were to then come on to say the daily, the 12-hour candle, the 4-hour candle, you would see the exact same thing happening where liquidity is targeted before moves happen in the market. And that's internal range liquidity. And I'm going to do a separate video on external versus internal range liquidity. But again, it's just getting you thinking about how price actually moves. Price sweeps liquidity, old highs, old lows. It then shifts and you see true market structure shifts. And then you get proper moves in the market that you can trade. If you're using, I'm going to call old school ways of mapping structure, you are going to hit some winning trades, but you're also going to get hunted a lot and you're going to get stopped out of trades and reading the market in the wrong way. So just to close out, I want to just cover some common mistakes. Always be cautious buying and selling above or below old lows. Breakouts look very enticing, but you don't want to get trapped in false moves before reversals. And the way to really spot that is to make sure that you're not buying breakouts around strong liquidity pools like old highs and lows. Stop placing your stop levels at those exact areas as well. And just be very conscious about where your stop sits in relation to highs and lows that are being created in the market. Because, for example, if we come back here, we bring up this monthly candle, this high is not created until the last day of the close of this month. As soon as this monthly close occurs, that then becomes a liquidity pool, an old high that we can target. So just be very conscious of time in relation to your trading and when candles are closing, because what can look like a good bullish trade can very quickly turn into a bearish trade. Always trade with higher time frame context. Always trade, in my opinion, candle ranges, higher time frame candle ranges. Check out a lot more of my videos on how to do this. And I like to always enter with confirmation. I don't like to blindly short this area. I like to actually wait to see some structure that I can actually trade from. And that's why I always track all of my internal range liquidity. Today we've been looking at clean charts, but if you actually trade with me, you'll see that I track everything across all time frames so that I have a strong picture of where liquidity is and how price action is occurring in the market. So just to conclude, liquidity sweeps are extremely important to your trading. A liquidity sweep is when old highs, old lows are targeted essentially in order to fill for large institutions to fill big orders in the market before distributing those orders in often reversal moves or continuation moves in line with higher time frame candles. Hopefully that's been useful for you guys, and there's a lot more content coming on this, and I will see you on the next one.